Hello and welcome to session 31 of Direct Tax to 4th semester BCom of Mangalore University. Now, we have already completed 3 heads of income. We will now be moving to the 4th head of income, and that is capital gain. A very interesting chapter. And in this particular session, we are going to learn as to what do you mean by a capital asset? What are the elements of capital gain? Then meaning of capital assets, exception to capital assets, and kinds of capital assets. So these are a few aspects that we are going to discuss in this particular session. Now, what do you mean by capital gain? Section 45, subsection 1 of the Income Tax Act says, capital gain refers to any profit or gain or profit arising from the transfer of a capital asset effected in the previous year by the SSE. So, any profit arising on the transfer of a capital asset, meaning to say, if you just own a capital asset, there is no capital gain. But if the same capital asset is transferred in the previous year, and that will result in capital gain. So two very important elements of capital gain. One is existence of a capital asset, and second, sale or transfer of a capital asset. So capital gain will arise only when the capital asset is sold or when it is transferred. Now, what do you mean by capital asset? What are the examples that we can take for capital asset? It refers to property of any kind held by an SSE. So when we say any kind, it includes goodwill, leasehold rights, land, building, jewelry, route permits, more so in case of transport business. Then we have patents, we have trademarks, shares, business assets, debentures, you can go on. So capital assets are these assets. It's not a complete list. There may be other items which may be missing, but basically these are capital assets that we are looking at. Now, assets, capital assets can be tangible, it can be intangible. Like for example, if you take goodwill, if you take patents, if you take trademarks, all these are intangible assets. But if you take land, if you take building, if you take jewelry, if you take shares, these are tangible assets. And whether these assets are movable assets or immovable assets. Then there are certain exceptions to capital assets. Assets which are not treated as capital asset for income tax purpose. Which are those? One is stock of raw materials, consumable stores, stock in trade, that is finished goods, which are held for the purpose of business or profession. So stock of raw materials, stock of finished goods, say closing work in progress, or we say semi-manufactured goods, or consumable stores. All these are stock which will be used in business. So such stock, though they are assets, they are not included in the meaning of capital assets for the purpose of computation of capital gain, if in case it is transferred. Second, assets which are meant for private use of an SSE or any of the family members of the SSE, excluding jewelry. Jewelry is a capital asset. Other than jewelry, let's say a motor car, let's say a two-wheeler, let's say a refrigerator, let's say a computer. All these assets, if it is meant for private use of an SSE, then such assets will not be treated as capital assets. Jewelry is a capital asset. A land is a capital asset. A building is a capital asset. So let's understand this. So other than jewelry, land and building and shares, debentures or securities owned by the SSE, all the remaining assets which are meant for private use are not included in the meaning of capital assets. Next, we have agricultural land situated in a rural area. So Income Tax Act has defined rural area. There is 2 kilometers, 4 kilometers, 8 kilometers, as well as related population as well. Suppose in the problem it's given, agricultural land situated in a rural area is transferred. That means to say such agricultural land is not a capital asset and the SSC is not liable to pay capital gain tax. So rural area word and agricultural land is a very, very important concept that we have to understand as far as capital assets is concerned. Next, we have special bearer bonds issued in 1991, 6.5% gold deposits bonds issued in 1977, 7% gold bonds issued in 1980, national defense gold bonds issued in 1980, gold deposit bonds under the gold deposit scheme. All these are not capital assets and they are not liable for capital gain. So let's understand this very clearly. So special bearer bond, 6.5% gold deposits bonds issued in the year 1977, 7% gold bonds, national defense gold bond, gold deposit bond, and gold deposit scheme. These are not considered as capital assets. Now, in the capital gain concept, we have two kinds of capital assets. First one is a short-term capital asset, and the second one is a long-term capital asset. Now, what do you mean by short-term capital asset? So any capital asset which is transferred by an SSC within 36 months. Now, there are different assets with different time period, but I'm taking the general time of 36 months by an SSC within 36 months of the acquisition of the asset. So if an asset is purchased and if it is sold, say within 36 months, that is within 3 years from the date of acquisition, then such an asset is treated as a short-term capital asset. But if the same asset is transferred or sold by an SSC after 36 months, that is from the date of its acquisition, then such an asset will be treated as long-term capital asset. Now, some notes. I mentioned 36 months is the general time period, but there are some assets, which are held for 12 months and more than 12 months. Some assets which are held for 24 months and more than 24 months. So we will look at each of the item. In the case of shares and listed securities of companies, that is bonds, debentures, zero coupon bonds, units of UTI, Unit Trust of India, and of approved mutual funds, which is covered under section 10, subsection 23D, these will be considered as long-term assets if they are transferred by the SSC after 12 months from the date of their acquisition. So debentures, bonds, securities, listed securities of companies, zero coupon bonds, unit of UTI, approved mutual funds, which are covered under section 10, subsection 23D, the time period is 12 months. If an SSC purchases such securities and sells it before the completion of 12 months from the date of acquisition, then such asset is treated as short-term capital asset. But if the same securities and bonds are sold after holding for more than 12 months, then such asset will be treated as long-term capital asset. Next is in case of residential house or land or both transferred, it will be treated as a long-term capital asset if it is transferred after 24 months from the date of its acquisition. That is 2 years from the date of its acquisition. But if the same residential house, land, or both are transferred within 24 months from the date of its acquisition, then such an asset will be treated as a short-term capital asset. Remember this. Different assets have different periods of holding if we have to call it as a short-term or a long-term capital asset. So let's look at such items now. When do we treat an item as a short-term or a long-term capital asset? Immovable property, that is of land and building, land or building or both. If the period of holding is less than 24 months, if it is transferred within 24 months, then that asset becomes a short-term capital asset. But if the same immovable property is held for more than 24 months and thereafter it is transferred, that asset becomes a long-term capital asset. Listed equity shares. Listed means listed in any stock market. And equity-oriented mutual funds. If the period of holding is less than 12 months, then such asset is a short-term capital asset. If the same listed equity shares or equity-oriented mutual funds are held for more than 12 months, then automatically it will become a long-term capital asset. As far as unlisted shares are concerned, not listed in any stock market, if the period of holding is less than 24 months, then that asset is going to be a short-term capital asset. But if the same unlisted shares are held for more than 24 months, that is from the date of its acquisition, it becomes a long-term capital asset. Now, as far as the debt mutual funds are concerned, if it is held for less than 36 months, then that asset becomes a short-term capital asset. If the same debt mutual funds are held for more than 36 months, it becomes a long-term capital assets. Then as far as other assets are concerned, the period of holding, if it is less than 36 months, it is treated as short-term capital asset. And if for other asset, the period of holding is more than 36 months, it becomes a long-term capital asset. So these are the list of assets. And what is the relevant period of holding to treat an asset, whether it's a short-term or whether it is a long-term. So basic point that we have to remember, as far as listed securities are concerned or equity-oriented mutual funds, period of holding less than 12 months is short-term, more than 12 months is long-term. As far as the land, building or both are concerned, if the period of holding is less than 24 months, that is from the date of its acquisition, it is a short-term capital asset. If the period of holding is more than 24 months from the date of its acquisition, it's a long-term capital asset. And the last one is other assets, jewelry that we are talking about. If the period of holding is less than 36 months, then it's a short-term capital asset. And if the period of holding is more than 36 months, then such assets will become long-term capital assets. So this is about the meaning of capital gain, the types of capital asset, exceptions to capital asset, and the period of holding of various capital assets. So that's all in this particular session. Thank you.